Try to influence interest rates. They don't try to influence credit market conditions. They don't try to slow down exodus of dollars or speed up the entry of dollars or vice versa. They don't lend to commercial banks, so they don't have a discount rate policy. They leave the interest rate to the financial market. They don't conduct open market operations or otherwise pursue any target on the interest rate between banks, the way the Federal Reserve does. So an ironclad exchange rate fixity is the one objective. So I'm going on at length about this because I think there are certain attractions to this kind of arrangement. Now, by holding treasury notes or bonds in the anchor currency, the currency board earns an interest income, as did the historical Bahamian currency board. This is enough to cover their expenses and return some profit to the shareholders, typically the government. But coming back to the history that led to where we are today, after the Second World War, under the Bretton Woods Agreement formed after the war, the British pound was fixed to the US dollar at a fixed exchange rate under the Bretton Woods system. Right? A pound was worth $2.80. And since Bahamian pounds were fixed to sterling, they were effectively fixed against the US dollar. So you had fixed exchange rate between the Bahamas and the United States. But then the UK pound devalued, dropped down from $2.80 to $2.40. It had to because the Bank of England had been pursuing an inflationary monetary policy inconsistent with maintaining the fixed exchange rate. When the pound is losing value faster than the dollar each year, right, it can't continue to buy the same amount of dollars when it can't buy the same amount of goods that that number of dollars can buy. People want to redeem their pounds for dollars so they can buy more. So they devalued. That devaluation was a shock to the Bahamas. Right? It made dollar-denominated goods more expensive overnight. Sterling bank accounts lost 14% approximately of their purchasing power over US dollar-denominated goods. I'm sure no one here is old enough to remember that event, but you may remember your parents complaining about it. That was a joke. So to establish a new durable link to the US dollar, the sterling currency board was replaced by the Bahamas Monetary Authority, which began issuing Bahamas dollars, pegged one-to-one to the US dollar. But that was a short-lived arrangement. It was replaced in 1974 or 73, shortly after independence, by the Central Bank of the Bahamas. Now, what's the difference between the Central Bank of the Bahamas and the Bahamas Monetary Authority? Well, I looked at the website of the Central Bank of the Bahamas, and here's what they had to say about the Bahamas Monetary Authority. Maybe you can guess what their view is going to be about whether this was an adequate arrangement. They emphasized that the BMA did not have, quote, the legal authority to employ active monetary policy measures, which means that the monetary authority could not do the sorts of things the Bank of England do, which forced it to devalue, so maybe that's not a bad thing. But the Central Bank of the Bahamas goes on to say that this constraint on monetary policy was, quote, a serious shortcoming of the BMA, unquote, and, quote, a fundamental weakness, and, quote, a deficiency. And this is all in the same paragraph. So they weren't leaving it obscure how they felt about it. My view is different. And I don't think I'm alone among economists. I think in the economics profession, we've rediscovered the old idea, the old truth that having a firm constraint, or what we now call a pre-commitment, in contrast to exercising discretion, making decisions day by day, unconstrained by any long-run binding rule, actually enables you to get better results. Right? And Kydland and Prescott won a Nobel Prize in economics basically for this insight. And some people found it surprising when they made this point, because they said, you know, how can having fewer options make you better off? How can it improve your range of choices? And the answer is that if people don't know what you're going to do tomorrow, they're not going to trust you as much. you may make some vague promises, but they're not going to be believable. And so if people don't trust you, then you're going to get worse results. They're going to be suspicious, and every time it looks like you might be inflating a little, you're going to have an inflation scare, and people are going to run away because you're not committed to undoing it. So if you put it the other way around, discretion, the discretion to run an active monetary policy, or what you could also call a Keynesian monetary policy, actually weakens a currency. And in the case of a pegged currency, it weakens the peg by opening the door to the monetary authority running a policy that's inconsistent with maintaining the peg. And if you want an example of a pegged system that did that and ran into trouble, I don't want to push this parallel too much because I don't want to be an alarmist, but look at Argentina. Argentina had a 1-to-1 exchange rate between the peso and the US dollar, but they did not abide by the rule that said when people come to redeem pesos for dollars, you need to shrink the supply of pesos, let the supply of pesos shrink until you strengthen the peso enough that the outflow stops. They did all kinds of unorthodox things. In particular, they lent an awful lot of money to their government, and they justified it on the grounds that, well, these are US dollar denominated assets. Well, yes, but they're not safe assets because the Argentine government did not have the revenues to repay its debts. And eventually it crashed, but it didn't crash because pegging the exchange rate was a bad idea. It crashed because they didn't establish a strict currency board. They had a central bank that was not fully committed to the peg and pursued policies inconsistent with maintaining the peg. So if you want, look at it from the point of view of a consumer or a money holder. If you want to keep money balances that will be assured to maintain their purchasing power over goods priced in US dollars, then you either want to hold US dollars directly, or you want to hold a currency that cannot embark on a policy that forces it to devalue against the dollar. Right? You want a devaluation-proof currency. And I don't know how else to explain why I'm told under the table so many Bahamians have US dollar accounts, and since they're not allowed to have them in Nassau, they have them in Florida. I don't know why else, or what other reason there would be for the Bahamian government to make it illegal to have onshore US dollar accounts. So we can describe the monetary system in the Bahamas today as a fiat currency, but pegged to the US dollar 1-to-1, and with the additional wrinkle that US Federal Reserve notes that are brought in by tourists are very commonly accepted. I got into a discussion with Wendell Jones today about whether businesses are allowed to give change in US dollars. And he said, well, they will, but not technically. They're not supposed to. I said, can they open bank accounts in US dollars? Oh, no, absolutely not. We believe in sovereignty. I said, well, is it an affront to your sovereignty that you import cars from the United States? But why was it an affront to your sovereignty to import currency from the United States? And I'm not saying it's necessarily better, and for sure I'm not saying US cars are better than Japanese cars, or Korean cars or European cars. So the question is, what do consumers want? But if consumers would rather have US dollars, then why are you stopping them? So US dollars are accepted, but they're not allowed to circulate. And they're not allowed to be used as reserves by commercial banks for US dollar accounts. So the central bank conducts monetary policy, right? It's not passive the way a currency board is. Conducts monetary policy with an eye to avoiding devaluation, and I give them credit for not having devalued yet. But it's not a currency board, and if you read their website, they say they have that they have other things on their mind too. They don't consider their mandate as binding as that of a currency board. Here's what they declare, that they look at many indicators. Quote, in formulating its monetary policy, the central bank takes into consideration the prevailing and prospective domestic economic situation, fiscal operations, and emerging external sector developments. In particular, credit and liquidity conditions are continuously monitored by the central bank.